What is the best oil and gas company to buy now? We're going to look at two huge undervalued companies, both ExxonMobil as well as Chevron Corporation. We're going to look at see how these companies have performed, their historical performance. We're going to look at their dividend safety as well as their essential financial metrics, looking at a ton of information for each of these companies. And we'll also see which company has the better balance sheet, or in fact, if they both have strong balance sheets, which you should be happy to hold for many years. And we will analyze their performance against some competitors on the year to date as well as the last 5 years. And as always, we will run through to see which one is better valued or what margin of safety we can get on either company and our acceptable buy price for both Exxon and CVX. Now, jumping straight in, we can compare how these companies have performed. Now, year to date, ExxonMobil is down 3.3%, so not that bad considering the oil industry as a whole. And we see CVX down significantly further at 17%, right there towards its 52-week low. However, with Exxon, it is slightly more towards the mid-range. Now, ExxonMobil does currently offer a yield of 3.7%, which is lower than Chevron's 4.17%. So you are locking in a higher yield now with Chevron, as well as a company that is right there at its 52-week low. Now, comparing how these companies have both done over the last 10 years, you'd see CVX up around 10 years, up 17%. We do see it hit its peak at around $186. But remember, although this doesn't include those dividends reinvested, that is a fairly poor performance over that period. When we compare that to ExxonMobil, they are up slightly lower at 8%, but we can see in actual fact they are right there towards their 52-week high. In fact, their all-time high of around $120. So both companies we can see haven't had the greatest year-to-date performance, both down. In fact, although Chevron is at a lower rate, down 17%, but it does offer a stronger yield of 4.2%. Now, when we take a quick look at their balance sheet, if we take a look at ExxonMobil, they currently sit with a $33 billion amount of cash on their balance sheet in their latest quarterly report, which has gone up significantly from the last 5 years, sitting at $3 billion. So nearly, or in fact more than 10 times growth on their balance sheet in terms of cash. When we compare that to CVX, they held around $10 billion 5 years ago, and now they hold significantly less at $6 billion and significantly less than ExxonMobil. So ExxonMobil, they hold $33 billion worth of cash. When we compare that to their total debt numerically and directionally, we see this from $38 billion to around $41 billion. So it has increased, but we can see the total debt isn't too far off their total cash. Now, when we compare that to CVX, which holds around $6 billion, looking at their total debt numerically and directionally, we see this in fact drop from $35 billion to $20 billion. So yes, CVX does hold a less amount of cash and it has decreased from the last 5 years, but the opposite to ExxonMobil, they have been paying off their total debt and this has decreased from $35 billion to $21 billion. Although when we compare like for like, ExxonMobil has roughly the same amount of cash that they do total debt, whereas CVX has significantly lower amount of cash, as we see here, $6 billion cash versus their $22 billion total debt. So we will take a look at that when we look at their net debt to EBITDA metrics. Now, over the last 5 years, let's take a look at how they've performed in the oil and gas industry. We also have Shell, BP and OXY, which seems to be Warren Buffett's favorite company. Now, year to date, we can in fact see Shell has been the best performer, up 22%. ExxonMobil, so if you have been reinvesting your dividends, you would essentially be flat on your position year to date. Chevron, you would be down 13.5%, and we can see they are the worst performing in the industry year to date. Now, when we expand this to the last 5 years, we actually see that ExxonMobil has been the best performing, up 64%, and we see Chevron in second place at 50%. So when you zoom out, both companies have actually performed very well, in fact the leaders in the industry, but as always, do remember past performance is never an indicator for the future. Now, dividend safety, we'll just take a quick comparison and then we'll run through each financial metric separately. ExxonMobil sitting at 80, whereas Chevron is sitting at a higher 90, very safe, and it does currently pay a higher yield. So with Chevron, you are locking in a higher yield as well as a higher dividend safety score, but do note that ExxonMobil's is still safe. So let's run through ExxonMobil's and then we'll get on to Chevron. So we see a market cap of 412 billion. They are a mega cap company. And when we take a look at some recessionary metrics, they did increase their dividend during the 07-09 recession. Negative sales of 41%, so this was significantly lower than the average growth of companies in the S&P, which was just negative to a lower degree. But interestingly, the opposite effect, they actually outperformed the S&P with a negative 28 to S&P's negative 55. In fact, we can just compare Chevron side by side. So when we take a look at the recession metrics, although they also did in fact increase their dividend during the 07-09 and had worse off negative sales, they did still beat the S&P negative 34 versus the S&P's negative 55, although we do see ExxonMobil have a slightly better recession return. Now when we take a look at ExxonMobil's dividend growth, 4.4% increase this year, so above that 4% I always advocate on the channel to keep it up in line with inflation. 3% over the last 5 years, so not the greatest, lower than inflation, and over the last 20 years, 7% on average. So it is positive to see that even in the long term, you are beating inflation with this oil giant. Now, when we compare that to CVX, 6.3% increase in January, so that is positive to see a larger increase with this company, a larger 5-year growth, 6% every year, and over the last 20 years, 7%, which as we can see is the same as ExxonMobil. So over the long term, both companies do have a nice increase in that dividend, higher than that inflation rate that I always say. Now, it is quite important to see this. ExxonMobil have been paying increasing dividends for the last 40 years, 10 years away from becoming a dividend king. 141 years of paying dividends without a reduction, an incredible feat for any company. And when we compare that to Chevron, looking at these numbers, they are a dividend aristocrat, both companies, with CVX in fact 15 years away from becoming a dividend king. Also a lot of years, 111 years of paying a dividend without a reduction. So both companies looking very well on that dividend front. Now when we analyze dividend yield theory, and remember, it states that the company is undervalued when the current yield sits above the 5-year average. We see a sign for Exxon showing some signs of overvaluation given the yield at 3.69 is below the 5-year average of 4.78. But remember, we don't look at any of these models in isolation, and we will draw conclusions towards the end when we run through the valuation. Forward P, however, is slightly lower at 11.5 versus 12.8. And when we compare this to Chevron to see what this difference is, we see that in fact Chevron does look to be reasonably valued / a slight sign of undervaluation with the 4.17% yield versus the 5-year average of 4.04, and forward PE still lower than the 5-year average of around 10 versus the 5-year average of 13. So it looks to be so far that Chevron, based on dividend yield theory, does seem to be essentially a better value right now, but we will go through the other metrics to understand fully this. Now, free cash flow payout is personally what I prefer, earnings susceptible to manipulation by management through accounting. So below 40% for oil producers. Now, it is very volatile. It is also a very cyclical industry, but over the last 2 years, it has been around 40% or lower, with 2023 expected to be around that as well. So positive to see those dividends should be increasing so far based on the information that we have. And when we compare a like for like with its CVX, what we see, again, a very similar story, both around that 40% as well as 23 expected. So both have that dividend safety from what I can see, no issues there. And when we look at the free cash flow per share for ExxonMobil, 254 to 1390, nice growth over the period. Do note that COVID year of negative 0.61 free cash flow per share, but it is also expected to come down in 2023. Now, if we compare that to CVX, what we see in fact is they have had 4 years of very poor growth. In fact, their free cash flow per share was negative for those 4 years. It did pick up in 1950 in 2022, but again, similar to ExxonMobil, it is expected to come down. Now, when we take a look at ExxonMobil's sales growth, this just goes to show that essential cyclicality, some years of double-digit negative growth, followed by double-digit positive growth, and so on, the cycle continues. Now, numerically speaking, their top line has gone from 390 billion to 402, so we do see it decrease and then pick up, which is typical from a cyclical company. And when we run this again through CVX, what we can see is a very similar story due to the nature of the industry and the cyclicality. And again, we can see, in fact, a very similar story with their total sales decreasing before increasing slightly above the 2013 numbers. Now, what's important is to look at the shares outstanding. Both companies, as we can see, do return excess cash to shareholder pockets. 4.42 billion in 2013, 4.21 for ExxonMobil. And when we compare CVX, very similar, although do note with CVX what they did do in 2020 was issue shares to dilute your position. So in fact, CVX's shares have gone from 1.93 to 1.94, although in both of their earnings I do believe that both companies are looking at doing a share repurchase program, so we should expect both of them to decline over the next few years. Now, when we look at the ROIC, it is one of the important metrics that I look at when analysing a company. 10% or more is personally what I like to see. Gives me faith management are able to effectively allocate their capital. And we can see this. In fact, over the last 10 years, it has been fairly inconsistent. The last 2 years with the trailing 12 months, though, well above that 10%. And when we compare that to CVX, we see a fairly similar story. 8% in 2021, before 21%, and then a trailing 12 months of 15%. So both companies, there isn't that much to really separate them when we do analyse them so far. Both margins, when we look at, they do struggle for oil producers across the board, and I would believe a very similar story to be told for CVX, as we can see, although you could argue over the last few years CVX has been performing slightly better on the margin front. Now, net debt to EBITDA is very important for these companies. It does show us the strength of the balance sheet, and as we did see for ExxonMobil, they did have a better balance sheet in my opinion, just very quickly going off their total cash versus total debt. And this shows us the number of years it would take the company to pay off all of their debt net of cash on hand. 2022 for ExxonMobil, 0.2 years. So that does show us that very strong strength, as well as 2023 expected to be even lower. So I can see why we do have a nice safe score. Now, when we look at CVX, I would expect it to be slightly higher, but in actual fact, it is roughly in line with ExxonMobil at 0.17, although it is expected to go higher in 2023, but still not high enough to warrant any worries like we saw in 2020 and 2016. So both companies do have a relatively safe dividend, and if I was a dividend investor, I would not be worrying about these dividends at all in either company. Now, what we can do is jump straight into the valuation, and we'll start off with ExxonMobil. Now, typically on the channel, as you know, we run through each model. We have Graham's valuation, multiples valuation model, dividend discount, the DCF, and then the intrinsic value. But for today's episode, we're going to jump straight into the valuation numbers. And as always, if you enjoy the content, value is being provided, do smash that like button, hit the subscribe and bell button so you are continually notified of these videos as they drop. Now, the stock valuation model for Exxon is coming to $129 as the intrinsic value. Current price at $103. Now, margin of safety, what I'd start off with, 10% if you believe it has a wide moat, strong financial metrics, good forward-looking data. Now, what we can see, it is a buy if you believe that to apply up to $116. At 15%, it's still a buy up to $110. And at 20%, it's still pretty much bang on right now, the price. So you are looking at a 20% margin of safety with ExxonMobil. Now, in terms of Wall Street and what they believe, well, they see the share price pretty much in line with our intrinsic value. So you are looking at some very nice upside with this company, around 25%. So for ExxonMobil, to wrap it up, what we are saying is you are locking in a 20% margin of safety based on our estimates and judgments, with Wall Street effectively forecasting a 25% upside. Now, we can jump in and do the same for CVX. And as always, if you enjoy the content, value is being provided, do smash the like button. Hit the subscribe and bell so these videos are literally being notified and dropping on your doorstep as and when they are delivered. And don't forget, if you do want to grab a copy of the intrinsic value calculator to get to the intrinsic value and acceptable buy price of companies in your own portfolio or watch list, do click on that pinned comment below. So the current price for CVX is around $145 with our intrinsic value at $172. Now, margin of safety, as always, we start off with 10%. If you accept that, it is a buy up to $155. At 15% at $145. So you can see right now, effectively, you are locking in a 15% margin of safety based on our estimates and analysis. So we do believe right now ExxonMobil is at a slightly better value than CVX. In terms of Wall Street, well, they believe the forecast of the price to go even higher than what we've calculated as the intrinsic value. So Wall Street do see a lot of value with CVX right now. So to essentially wrap up, what we see with ExxonMobil is a 20% margin of safety to current prices, with CVX around 15%. So both companies, you are effectively getting a nice margin of safety, although it does depend on what rate you would be looking. As always though, do let me know your thoughts in the comments. Are you looking to add ExxonMobil or CVX, or is this one that you accumulated many years ago when it did drop quite significantly and you don't want to be adding anymore and have a very nice yield on cost? Personally, I do believe them both to be undervalued and buys now, with one slightly better, but as we saw, both companies have very strong balance sheets and both companies do look to be able to pay dividends for the foreseeable future. As always, if you do want to grab a copy of the intrinsic value calculator to get to the intrinsic value and acceptable buy price of companies in your own portfolio, your wish list, or even if you want to run through this again but on your own estimates, do click on that pinned comment. We'd also love for you to join us in the Discord, talking all things buyers and sellers in the market, so do click on that Patreon link as well. As always, drop your comments, smash the like button if you've enjoyed today's episode and want more of the similar. Do also hit the subscribe bell so you have these videos every single day delivered when they drop. Have a great day and catch you all on the next episode. Take care.